Hey everyone, welcome back to Corporate Decoder. Today we are diving into a company report that has a director saying, "I'm out." Let's see if this is a normal retirement or something more juicy. We're looking at a report from Penumbra filed in February. This is what's called an 8K, which is a current report companies file when something important happens that investors should know about. The main event here is that Don Cassing, a member of Penumbra's board of directors, is retiring. He told the company about his decision in February, and his retirement will be official in April. The report specifically mentions that Cassing's decision wasn't because he disagreed with the company on anything. This is important because sometimes when board members leave suddenly, it can signal trouble, like disagreements about how the company is run or even potential wrongdoing. But here, they're saying it was just a regular retirement. To make sure everyone knows about this at the same time, Penumbra put out a press release about Cassing's retirement. This is to follow something called Regulation FD, which means fair disclosure. It's a rule that says companies have to share important information with everyone at once, not just a select few. You can find the actual press release attached to this report as Exhibit 99.1. Now, let's zoom out and think about what this means for Penumbra. Board members play a vital role in guiding a company. They're like the strategic advisors helping to make big decisions about where the company is going and how it's going to get there. So, when a board member leaves, it can have an impact. In this case, it seems like a planned and amicable departure. The company is saying there were no disagreements, which is good, but still, Penumbra will need to find someone new to fill Cassing's spot on the board. Now let's step back and take a broader look at Penumbra, considering this change. Penumbra is a medical device company. They create and sell products used in procedures for things like stroke and other neurovascular conditions. It operates in a complex and heavily regulated industry. The company's success depends on a few key things. First, innovation. They need to keep coming up with new and improved devices to stay ahead of the competition and meet the evolving needs of doctors and patients. Second, regulatory approval. Medical devices have to go through a lot of testing and scrutiny to make sure they're safe and effective. Getting approval from regulators like the FDA is crucial for Penumbra to sell its products. Third, market access. Even if they have a great product, they need to be able to get it into the hands of doctors and hospitals. This means having a strong sales force and good relationships with healthcare providers. Looking at Penumbra's strengths, they seem to be a pretty innovative company. They have a track record of developing new devices that address unmet needs in the neurovascular space. They have also been expanding their global presence, which can lead to further growth. However, there are also some risks to keep in mind. One is competition. The medical device industry is very competitive, with lots of companies vying for market share. Penumbra needs to constantly innovate to stay ahead. Another risk is regulation. The regulatory landscape for medical devices is always changing, and new regulations could make it more difficult or expensive for Penumbra to get its products approved and sold. A third risk is product liability. Because medical devices are used in delicate procedures, there's always a risk of product malfunctions or complications that could lead to lawsuits. Considering all of these factors, what's the outlook for Penumbra's stock? To get a sense of valuation, we can look at some basic metrics. Because I don't have all the latest financial figures, I can't give you precise numbers, but I can illustrate the general idea. One common metric is the price-to-earnings P/E ratio. This compares a company's stock price to its earnings per share. A higher P/E ratio suggests that investors are expecting strong growth in the future. Another metric is the price-to-sales P/S ratio. This compares a company's stock price to its revenue. It can be useful for valuing companies that are growing rapidly but aren't yet profitable. Finally, we can look at the company's debt levels. High debt can be a red flag, as it can make it more difficult for the company to invest in growth and weather economic downturns. Overall, Penumbra seems like a company with potential, but also with some risks. Their innovation and global expansion are positive signs, but the competitive and regulatory environment could pose challenges. Based on this high-level assessment, a reasonable price range for Penumbra's stock might be, to provide an example, between $200 and $250. This assumes that they can continue to innovate and grow while also managing their risks effectively. But keep in mind that this is just a rough estimate, and the actual price could be higher or lower depending on market conditions and company performance. In conclusion, while the departure of a board member is always something to keep an eye on, in this case, it appears to be a normal retirement. Penumbra faces both opportunities and risks. I'd give Penumbra a slightly bullish rating, leaning on their innovative record. Thanks for watching. If you found this analysis helpful, please subscribe to Corporate Decoder for more insights into the world of business and finance. Don't forget to like and leave a comment below.